Thanks everyone for your patience. Tim is ready to go, so I'll just turn it over without further ado. And Tim, take it away.
Well, thanks, Chris, and thanks everybody for your patience as we work through the technical difficulties. Hopefully the Zoom platform holds up and we can get through the presentation. Yeah, we'll just leave it at that. We're going to move on. So we will get the presentation up and be talking about the PEA is what we're going to be talking about today. So there we are. So yes, we are very pleased with our PEA. It's been a bit of a year in last year in 2022. We started this process in April and just recently, of course, finalized the numbers and we're able to release that. And I'm sure some of you have had a look at it. And hopefully everybody's excited about it as we are. But let's just go through the details and I can point out why we are so excited. For those of you who are not familiar with the company, Granite Creek, we are a member of a group of companies, the Metallic Group. We have two other companies in the group, Metallic Minerals, Stillwater Critical. And our business approach for all three companies was to acquire large brownfields land packages at the bottom of the metal cycle and use modern exploration techniques to advance those. Now, Granite Creek is the first company in the group to publish an economic study on our Carmax project. And we were the first company in the group to have formal resources. But now the other two companies do have resources and are in the process of expanding those resources, adding pounds or ounces to their books. So very good group to be a part of, very good progress in all three companies. And I encourage you to add all three of our companies to your watch lists and follow along if you don't already. But we're talking today about the Carmax project and the recently published preliminary economic assessment, PEA, on the Carmax project. Just a snapshot of the project. We have 43-101 compliant resources, of course, which we needed before we could launch the PEA. And those 43-101 compliant resources, over 650 million pounds measured and indicated. Of course, the PEA does not contemplate mining all that. Once you start to constrain some of that to some economic factors, some of it, you know, based on metal prices, strip ratios and that, don't make it to the mill. But we've delivered a really strong net present value of 324 million with a 36% internal rate of return, IRR. Our projected cash costs are $1.77 a pound copper equivalent. So that's using the gold and silver. That's not net of byproduct credits. That's just treating everything as if it was copper. And an all-in sustaining cost of $258 US, which when you look at metal prices today of over $4, I think we're at around 420, maybe a little bit lower today. We've got some pretty strong economics. We're really pleased with it. But having said that, we believe this is just the beginning or maybe another beginning for the project because we see significant upside potential, both in the discovery of additional resources, which we've got 4 new very compelling targets that were developed from work that we did last year, including geophysics and geochemistry. And those targets are very close to the proposed pits and the proposed mine infrastructure. So we think with a modest drill campaign to be executed this summer, we can definitely add to mine life. And we also have some very interesting metallurgical work to do in the coming months that we think can add significant value to the project as well. So the project is close to infrastructure, close to grid power. We're proposing at this stage to bring power across the Yukon River, less than 20 kilometers away, very short power line. And of course, the access to our project is currently being upgraded by the Yukon government. The road, the Free Gold Road, the access to the mining projects, ours and beyond ours, That money is being put forward by the federal government, and that work has started and is ongoing. So very good infrastructure for the project. And some of the PEA highlights, we looked at two cases. So we have in the news release that we published last week, we have, and in this presentation, we have a more fulsome sensitivity table. So you can sort of envision where metal prices would go and how they would affect the project. But there was two cases that we wanted to point out that we thought were relevant. Was a base case based on 3-year trailing average price of metals, including 375 copper, 1,800 gold, and 22 silver. That base case gives us that 324 million internal rate of return before tax and 228 after tax. Payback on the project is 2 years, which is great. It means we get into positive cash flow very early on in the project. And life of mine, undiscounted cash flow is over $368 million. Why we used a case one is we've seen some analysts out there predicting much higher copper prices moving forward. We've seen prices being predicted everywhere from $4 to $5 this year. Now we're well over 4 now, and I think we've got a good chance of maintaining that for most of the year, if not all of it. And I think we have an opportunity to go higher. So we felt a 425 case one was valuable, including 2,000 gold and 25 silver. That increases the pre-tax to 475 million, after tax to 328, and reduces the payback period to 1.5 years. So again, we think some great possibilities for this project with a modest capital outlay. So initial capex is 220 million. Sustaining capital of 120 million, a lot of that is later in mine life stripping. As we move from one pit to another, there's a period where there's a bit of a pre-strip that a lot of that sustaining capital captures that. So what the opportunities, like I mentioned earlier on, the metallurgical possibilities. So late in the process, we realized that we were losing, in the study, we were losing a lot of copper in the tailings. We've gone back and forth with the engineers on this. We looked at various ways to improve that. And what we realized that we would have to do a study post-publishing of the PEA, because we just didn't have time to get the study completed in a timely fashion. But looking at material and the sensitivity that we ran on recoveries, we realized that increasing the recovery rate by only 20% gave us an additional 180 million pre-tax NPV. So we have material available to do this additional metallurgical work. That material has been delivered to a lab, and we've started on that work, and we think that can be done fairly quickly, depending lab time. It's not always easy to get that lab time, but this is a fairly modest study that, we see a lot of extra value there. And of course, I mentioned the additional near mine potential, 4 compelling targets that we believe we can add resources. And we haven't even touched on our Carmax North target area, where we've got multiple targets within 15 kilometers of the proposed mill site that would add mine life. One of the challenges that we had in putting the PEA together was the sequencing and the blending of ore. We saw very good recovery rates in metallurgical work that we did when we could blend ore 50-50, sulfide and oxide. And we even did some tests on 60-40, sulfide versus oxide. But the challenge is getting to sulfide at the time when you're processing oxide. So we think there's more optimization that could be done there. Discovery of more sulfide ore would, of course, help with that blending. That can get us back to that higher recovery rate that we saw in the met test. And it's all about sequencing, right? It's about when do you open which pit, how soon can you get to sulfide versus oxide ore, and can you bring that 50-50 blend to the mill? And again, we need to look at more optimization to get there, and I think we probably can. And then the last thing from the opportunities, the current opportunities that we see, is the mine right now is proposed to have a contract fleet. So the The project won't be buying its own mining equipment. It'll be leasing. And the idea would be to approach companies that have the ability to deliver electrified vehicles to the project. And of course, they would get preference. We see some cost savings on the op costs. And of course, the opportunity to reduce the environmental footprint on the project is worth exploring and worth chasing out. This, of course, it's a preliminary economic assessment, and these opportunities now we can roll our sleeves up and start to chase some of them out and see where these could be achieved as we move towards the feasibility study on the project. So again, I like to point out why we think we can get this increased metallurgical results. I know I've mentioned this a couple of times, but I think it's really important. We did a calculation on the grade of the tailings, and this is mostly when we're processing oxide ore or high percentages of oxide ore. So when the oxide ore in the mill is running sort of 70 to 80%, versus sulfide, we're seeing up to 0.32% copper in tailings. Now, we know from previous metallurgical work is that copper will leach. We've seen lots of studies that you can extract that copper with leaching. One of the challenges of this project in the past, when they looked at leaching, is then you'd have to go to a full SX-EW plant to produce cathode copper, which is pure copper at mine site, but your electricity charges are huge, and the cost of that SX-EW plant doesn't make any sense. So what we're looking at doing, we're looking at leaching those tailings and then chemically precipitating the copper into a sulfide mineral that would then go back into the circuit for further recovery. The lab that's doing the work for us, they've done work like this before. They know it's possible. And we think that, you know, with that amount of copper there, that we can improve those recoveries, we can improve our flow sheet and add to that value. So that work is underway. Now, if you look at the chart here, you'll see that when we did a 60-40 blend, we were getting 82% recovery. When we did a 50-50 blend, we got 75. Pure sulfide, we're getting 93. Oxide on its own, we were only getting 40%. We never optimized that study because we felt that we would be able to blend and that would solve the metallurgical problems. But we know by talking to the company that did this met work for us, had we optimize that study, we might have been able to take that 40 to 50 or even 60 in the oxide, which again is another opportunity to improve recoveries. Right now, we're running 64% life of mine recovery of copper, and we see that as a phenomenal opportunity to increase that. And if for that 64%, we're still getting those strong NPV numbers. So a lot of upside still for the project. So we just go through some of the sensitivities here. You know, if you're one of those procrastinators who believe that we're going to hit $5 copper, you can see even at base case, $5 copper gives us over 600 million. And if you add the $2,000 gold at the same time, we're up at about 650. Of course, that's pre-tax. Some of the other sensitivities we looked at, of course, the recovery is a big one. You know, a 20% increase in the recovery moves the numbers nicely. Copper price moves it as well. So if you had both recovery increase and copper price increase, this thing's going to sing. This will, you know, there'll be a lot of cash flow coming off this project. So those are the two things that are what we can't affect the copper price, but we can affect recovery. We can look at improvements in the OPEX, the operating costs, whether through electrification or some other things. Not a lot we can do with the CapEx, but that will be looked at as well as ways to further optimize the study as we move it towards feasibility. Of course, I like to point out that the Yukon continues to be an excellent place to work. We expect the Hecla mine to be back in operation sometime this year. I know I saw Hecla was in the process of hiring mining personnel. So we've seen majors like Hecla, Rio Tinto, Teck, et cetera, still have strong interest in the Yukon and are still advancing projects. Of course, one of the things I pointed out is that this PEA is done on the oval that is in the bottom of our land, or the southern portion of our land package, where these multiple zones sit. All the other zones in the northern part, A, B, C, Butter, etc., have not been included in this PEA, and we treat them as further upside potential for the project. There's our resource estimate. I would encourage you to download this presentation from the website and go through some more in detail. Of course, like I said, the resource has over 626 million pounds of copper in it. I believe the PEA contemplates mining around 420 million pounds of that, and some of that ends up in the tailings. So we want to improve that. So you see 3 conceptual pits. Now, the resource estimate contemplates these 3 pits. However, the current mine plan, as proposed by the PEA, does not include 2000 South. And the reason for this is that there's not enough strike length, so the strip ratio hurts 2000 South and doesn't make it economic. But we believe one of our targets may be within that proposed pit wall that was proposed by the resource estimate, which would assist bringing 2000 South into view. And of course, any additional material that's found in there, which we believe there still is, it's still open along strike, would help bring that into a subsequent review. So that currently is out, but it's an opportunity to do some more work, some more drilling, and bring that in. And then the IP survey and some of the trenching and geochemical work that we did. So on the 3 image or 4 images beside on the right hand side of your screen, the top one, we modeled the existing resource that was inputted into the PEA, and we saw the signature that we got from the IP survey. And then we did a bunch more lines, and 3 of them showed some very near pit potential resources that didn't have a single drill hole in them. So these are brand new targets for us. There was a zone, so that between 2000 South and 147, that we really felt there should be something there. And we modeled all the historical drilling, and I said, oh yeah, no, they've drilled it. So, but then when we did the survey, we realized that even though there had been drilling in the area, none of the drill holes pierced these new targets that we had. So these are really compelling. We see some geochemical indications at surface that this might be something down there. What we're calling the gap zone, is not that deep. We think it looks like it comes to within about 50 meters of surface. And again, this would help bring that 2000 South zone into view, to sort of reduce the strip ratio, to provide some material that is currently being categorized as waste by the PEA into an ore category, and possibly add, quite a few years to mine life should we be successful. And of course, as some of these go deeper, they will start to inform the potential for an underground operation later in mine life. Right now, we're not contemplating, we don't have enough resources that report at depth to contemplate underground, but with a little bit more discovery, that's something that we would start to work on as well. And of course, for those who've seen my presentations before, I love to mention the Minto mine. Couple numbers for you to take away from. Minto's guidance tells us that it's costed them roughly $40 a pound to bring ore from underground to surface. Our projected costs in this presentation, available in the news release, are $3.16 a pound, so under $4 a pound to mine. And then they've got a mill capacity of 4,200. We're proposing 7,000. Again, I like to point these numbers out because it gives some people a sense of what operation similar size. Well, of course, we're proposing a little bit bigger, but it backs our numbers up. You can look at their quarterly reports. You can see their cash flow, and we believe project where we are, we would be able to bring our all-in sustaining costs quite a bit lower than what they're currently producing. So, like I've always said, one of our goals is to attract a larger copper player to the district, possibly for acquisition of Minto, possibly for acquisition of us. And now that we've got the economics of our project out and you can compare it to Minto, I think the story here in the Minto Copper Belt is even more compelling. So, just about to wrap up. I've got a couple more slides to go through and then I'll take some questions. But in summary, we've moved really rapidly in the exploration phase space from our launch of the company in January 2019, acquisition of the Carmax deposit end of 2020, rapid growth of the resource in 2021, and now worked on the PEA for the most of last year and able to deliver really strong economics with a whole lot of blue sky upside to the project early in 2023. A lot of news that we believe that metallurgical work as we finalize our exploration program for 2023. We encourage people to follow along and come along for the ride with us. It's going to be a real interesting, real compelling year. We are centered in the Lassonde curve. Excellent entry point for investors. Again, do your own due diligence. Use Minto as a comparison. Use other similar size proposed mines like Cucho and that as a comparison for what we got. But we think this is a great point for people to have a look at the company and watch us as we move up the curve towards feasibility. A little bit about our team. Because we're a member of the Metallic group of companies, we've got a very strong technical team that works not only in our project, but in other projects. We have modeling experts that have really helped bring this resource into view and really help move the PEA forward. And we've got some really compelling people who really understand geophysics and geochemistry and have helped us a lot in advancing the project. And of course, the track record of success within the Metallic group, including Greg Johnson, who was the founder, one of the founders of Nova Gold in the early 2000s, taking modest resources at Donlin, Galore, and Ambler and turning them into world-class assets. And we believe we're on the same track with all three Metallic group companies with 4 significant assets. One of them, like I said, has a preliminary economic assessment. Not that it's a contest, but we're pretty proud to be the first one in the group to have that economic numbers out there and believe that we can even grow that even more. Share price, again, good opportunity, 8.5 cents. That's pretty cheap compared to our evaluation presented by the net present value of the asset. Even at 15% of that, it's much higher than that 8.5. Encourage everybody to add our stock symbol to your watch list. You can get my contact information from Chris. If you want to set up a call for a one-on-one discussion, we're happy to do that. In the meantime, what questions can I answer today about our preliminary economic assessment?
So thanks, Tim. There's a few that have poured in, and I'll just reiterate that just at the bottom of your chat window is the Q&A button. If there's any further ones, I was paraphrasing them, jotting down a little bit. So I'm going to be looking down as I read a couple of them. Speaking of the recoveries and the potential for that secondary oxide processing, is there a timing that you see for any of those results? And would that trigger an updated economic study based on that recovery change?
Well, yeah. So, I mean, that's something we'll definitely consider. I mean, if the numbers come back the way we hope, we would definitely look at it. That could be up to a 50% increase in MPV. So if the numbers are there, I think it would behoove us to put out an updated study, and we'll talk to SGS about the timing on that and what it would look like. Now, the timing on the met work is a little bit more challenging to envision because we do have the material at the lab, but we haven't booked the hours in the lab yet. We're working on a sequence with the lab to ensure that we can fit in, because we're basically fitting our project in between some other ones that they have on the go. Luckily, we had the material close at hand, so we didn't have to drill anymore to get that material available to do that additional work. But yes, lab space is always at a premium, and this isn't one of the regular assay labs. This is a mineral process lab here in Vancouver that works for big companies, helping them solve similar programs. You know, I know they've worked for Teck, they worked for Glencore in the past, and they don't see this as a big problem. But again, it's just, you know, trying to squeeze in that lab time. So our hopes would be we might get it this quarter, but at the latest, it would be sometime early second quarter. Again, once we get those results, it's going to take a little bit to, you know, to put them into context and get them out there.
It's like, okay, just I won't read it verbatim, but thematically similar. So targeting for, you mentioned pre-fees or fees, is there any sort of targeting on the horizon for what that would be, or is increase in tonnage, updated economics on a PEA level, is that sort of the trajectory and priority, or the deeper level study?
Well, yeah, I mean, the increasing in the tonnage is become one of our priorities. And to be honest, when we started the PEA process, it wasn't really as much on our radar as it recently has become. Now, the reason it has become more important is the modeling that we have done on that IP and geochem survey and trenching that we completed this summer. So we've got the results. There's still actually ratings from some lab results from some of that trenching, but has given us some higher confidence that there is additional resources there. Now, until you drill them out, of course, it's really hard to quantify, but the fact that they are so close to the proposed pits, in fact, a couple of our targets are in the proposed pits, just a little bit deeper in the 1213 pit. So that has really become low-hanging fruit for us, that we think, you know, we've got a 9-year mine life. I would have liked to see something in the teens, maybe, you know, 13, 14 years. But 9 with a 2-year payback is pretty compelling. And if we can show another 4, 5, or 6 years with a, you know, really a modest drill campaign, you know, this year, I think it's worth chasing. I think we can do it, you know, fairly economically. Of course, I'll remind people that this is a road access project. We won't be flying drills in, and this is on, most of the drilling will be on well-established drill trails in and around the work that's been done since the 70s. So it's kind of surprising that there would be these targets there that you know, for whatever reason previously didn't get drilled off, but they're there, they're real, and we're really excited to get on the ground and chase them out. And there's a long-winded answer to your question, or to the question, Chris. So hopefully that hit all the salient points.
It did, I think, and it also gave a couple of jumping off points. I wasn't quite sure which one I would go with for the next question, but since you mentioned accessibility and stuff, we'll switch to infrastructure a little bit. And I'm assuming, based on the phrasing of the question regarding new road projects and so on, that that's referencing the Resource Gateway project that is the joint effort of the Yukon government and the federal government. I know Casino was involved in their road as well, Carmax bypass, some other of those projects, and to what extent that impacts us at Granite Creek.
Oh, it has a huge impact, because we are road access, but it is even though it is a government maintained road, it's a challenging road at some times, especially in breakup and that, to get in and out. And that road is being upgraded. Like you wouldn't be able to bring con trucks down that road currently. So if we were to take the project now, if we started building the project now, there'll be a lot of money spent on that road. Now it's It's just about 40 kilometers from paved highway to our project access road. And that 40 kilometers is being upgraded as we speak. They started on the Carmax bypass. I think that is just about complete from what I understand. They stopped over the winter. And then they're just going to continue on down towards our project and beyond towards Casino. So when you have a third party building out your infrastructure for you, that makes a phenomenal difference to your capital costs for the project. So we see that as really compelling. Now, the other infrastructure one is power. Like we said, currently we envision bringing a power line across the Yukon River. That is the most direct route, but we are open to looking at other routes as we move towards more detailed studies, including coming down to Free Grow Road with the power line, which does have a higher cost but lower environmental impact. And if that power line is continuing on to other projects beyond ours, then you start to see some cost saving where you're sharing that initial outlay. So yeah, infrastructure wise, we think the project is very good. There are some things that are going to have to be worked on. It's not a slam dunk, but every issue that we see, we believe has a solution that is environmentally sound, and that in a lot of cases is being worked on by multiple parties to bring it forward.
Oh, exit strategy is always kind of a popular question right out of the gate. So there's that, but I think it can be bundled into a couple others that are asking questions about our relationship with Minto Metals next door, if that's the path, or if we see a larger player coming in taking out both is a question. And any thoughts on the illiquidity of our neighbors at Minto? So there's a lot there. Maybe just start with relationship with Minto, and if there's a path there that we see.
Yeah, so I believe, especially on the exploration front, we've got a very good relationship with Minto. Our geologists have visited their site. I visited their site during the Yukon Mining Alliance property tours last year. We recognize that the mineralization style at Minto is very similar to ours, and as well, their geologists have visited our site, looked at our core, and there's an understanding of geologically how the sort of projects would fit together, mineralization would fit together. As far as them looking towards us, I would be shocked if they didn't have their eye on us and look at resources down the road. At some point, a company like that has to be weighing their cost of discovery versus the resources down the road. Now, there's no discussions at this point. We haven't talked to Minto management about any sort of joint ventures or putting the companies together or anything like that. One of our goals all along has been to attract interest to the Minto copper belt for either a mid-tier to a larger copper producer that would recognize the synergies within the belt with our project with Minto and some of the ground between us, including First Nations owned lands where they are doing their own exploration for minerals between the Minto mine and us. We think there are a lot of synergies there, and I see just with having this study out, with showing the strong economics plus the upside, being able to get more interest, more eyes on the belt, and maybe there is a further consolidation or acquisition by a large player down the road. But we have no talks in that regard. But yes, that is our exit strategy, to bring that attention, and whether that is somebody that comes in with the deep pockets that helps us build a standalone operation, or somebody that comes in with deep pockets and recognizes in order for them to move forward, they need to control everything. It's hard to say at this point, but I think there is lots of opportunity now, as we've put some numbers on it, to bring that attention to the district.
Probably fair to say we see a lot of value that we can add before we start getting too deep into those conversations about who's going to be wanting to buy us out. We got to make them pay for that.
Mhm.
So you touched on it just briefly there with the First Nations. So maybe just relationships in the community and with the First Nations.
Yeah, so it's been an interesting a couple of years because of COVID. Our ability to get into the community and have the meetings that we would like to, I'd say, has been delayed. We're starting to be able to do that now. We've had some good meetings with development corporations, both with Little Salmon, Carmax First Nation, and with Selkirk First Nation, about some opportunities in and around the project, about the capacities that they would bring to the table. We are going to be working this year on community meetings at Carmax to present the project and present the opportunities and some of the challenges, and work as hand in hand as best as we can to address some of those challenges and ensure that that the benefit of the project goes to the people who are most closely associated with the project. And I think a project like this should benefit the people who are living close to it, whether it's Whitehorse, Carmax, or other First Nations and communities in the area. That's where the benefit should be to the highest degree. We did a small financing in December, and we launched that financing by going to the Yukon, sitting down with business leaders in Whitehorse and business leaders in some of the small communities, and brought it to their attention first before we went to the larger markets. And that's going to be, we're going to continue to do that. We think having investors close to the project is good, it's valuable. And I think there's a lot of initiatives that we can do with this project and with the local communities to build out that partnership.
So the question about the regulatory process, timeline for entering the regulatory process, it's probably been entered and is an ongoing thing, but I assume that's with respect to actual mine permitting and the deeper regulatory process. So we have talked to a couple consulting firms that specialize in the regulatory process, the permitting of a full mine, including a water license. We're told you're looking at sort of 24 to 36 months from get-go to complete that. If you look at some of the bigger projects in the Yukon, that can stretch out to 5 to 10 years. So we believe the size of this project, it's a modest project, 7,000 ton per day mill, is an advantage in that it's got a much smaller footprint. We've maintained water sampling on the project since it predates us, and we've kept that up, and we are starting to now put together what other studies that will need to be done as part of that work. So this summer we may not formally start that process, but we will start the studies that will inform that process, and we will be talking to there's two or three consultants that do that kind of work, and we'll be talking to them in the coming months about designing a timeline and a process so that we can start on that. And all of these initiatives, including coming drill programs and exploration, cost money. The question, do you anticipate additional equity raises going into, well, this says going into pre-fees and fees, but maybe just in terms of financings?
So you're absolutely right. The company will look to do a financing. We have in the money warrants right now that are starting to trickle in, and that's keeping us allowing to complete some of this work and start planning work and that metallurgical work that will be ongoing. And then we're going to continue to market this PEA. We're going to continue to get the work out. We're going to give time for the share price to do what the share price is going to do before we rush to a financing. We've got a buffer to get us through for the next few months, and then we'll be looking to raise some capital for drilling and to further the studies needed to move towards feasibility. And
addendum to that, it's just clarifying that likely that metallurgical work will happen we'll see that, and maybe that's those sampling results and things like that before there's financing launched.
Absolutely. Yeah, there's a lot of that we can do with the current cash on hand, and we're not sitting still by any means.
Last question. You talked about copper demand a little bit, but maybe broaden that out a little bit. And copper is classified as a critical mineral here in Canada, unlike in the US. And to what extent is that benefiting, or do you see that benefiting us moving forward?
Yeah, well, a couple things. Because it's a critical mineral, I think our sector is getting more eyes, and we're seeing investors who maybe are new to the sector, but they're understanding the impact of the greenification, whether it's electrical cars, which have 5 times the amount of copper in them versus a traditional ICE car, or if it's solar power, wind power, tidal, nuclear, they're all big users of copper. So it's a great driver, and I think that's why we're seeing the strength of the price, and I think the strength in the price is going to continue. And the other thing, if you follow the news, you'll note that we're seeing more issues with some of the big mines in South America and Peru and Chile, where they're sorting through some social economic factors that have not been addressed to their detriment. And I think as they sort through those, we're going to see more supply disruptions out of that part of the world, which is responsible for over 35%, if you put Chile and Peru together, of the world copper supply. On the critical minerals, the other thing about the critical minerals, of course, the federal government announced an increase to the tax credit when companies are issuing flow-through shares. So there's an extra 15% credit on a flow-through share. And of course, any financing that we'll do, we'll consider a flow-through portion of it to keep dilution down. And to give people those tax credits, so it helps reduce their risk. So that is great. It means that you'll see the premium of a flow-through share versus a non-flow-through share will be a little bit higher because of that tax credit. So just warning investors about that. If you'll see numbers that a little bit bigger gap than we've seen before, but it's also an opportunity to reduce your risk by participating in those flow-through shares. So again, it will likely be a component. We'll consider it for sure. We don't have any financings lined up now, so that'll be discussions with potential parties when we're prepared to start to put that together.
Okay, that is the end of the Q&A session, and I guess the end of the webinar. It's funny, Tim, yesterday you said it seemed like the PEA was going to be a milestone kind of finish line, but it's turned into a starting line for so many other new things that are coming. So thanks everyone for taking the time this morning or this afternoon, depending on where you are. Again, feel free to reach out to either Tim or myself. The contact info is on the website at gcxcopper.com. First initial, last names is the format for the emails. Look forward to speaking with you, and keep watching. Lots to come.
Yes, thanks everybody for taking your time out for this. Hopefully not too many people left the roundup floor for this presentation, but if you know anybody who was unable to attend and they would like it, there will be a recording available, and you'll be able to find that on the website.
Thanks everyone. Have a great afternoon.